You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Gold, crude oil, corn, soybeans, and more. With so many tradable products, the futures options market can be an intimidating place. How can you possibly keep track of the latest trading developments across so many different products? Don't worry, we've got you covered. Welcome to This Week in Futures Options, the program designed to help active futures options traders stay on top of this ever-changing marketplace. Each week, we'll break down the top trades, hot products, volatility explosions, and much more. This Week in Futures Options streams live, so be sure to check out our live stream via the Mixlr app. That's MIXLR. Or join our live chat room at mixlr.com/options-insider. Whether you're an experienced veteran or a newcomer looking to separate the wheat from the lean hogs, This Week in Futures Options has the information you can't find anywhere else. This Week in Futures Options is brought to you by CME Group, the world's leading and most diverse futures and options exchange. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This Week in Futures Options is also brought to you by FTSE Russell, a leading global provider of benchmarks, analytics, and data solutions. For more information, please visit ftserussell.com, cboe.com, and cmegroup.com. And now, get ready to break down the latest futures options trading activity. It's time for This Week in Futures Options.
All right, everybody. That music means we are back once again for TWIFO, This Week in Futures Options, the program where we break down all the action over there at CME. What's lighting up the tape to the upside and to the dark side? What's going on with the volatility, the unusual activity, the skew, all that good stuff, and a whole bunch more. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting, at least we like to think so, Options Insider Radio Network. Reminding all of you on-demand folks, if you like what you hear, keep rating and reviewing. It really does help. You could argue it's even more important now than ever, even though the network's been around for, 15-odd years. Those new reviews do help all the new people who are continuing to discover these markets and this content every day. Of course, if you want to go above and beyond, enjoy the live, ask questions live, not just for this show, but for pretty much everything we do throughout the week, and also get access to some other exclusive shows as well. TheOptionsInsider.com/secret club is the place to go. Not so much a secret anymore, but fun nonetheless. And of course, however you listen live after the fact, we want to hear from you folks. So your questions, your comments, your insights, your pearls of wisdom. We do indeed enjoy hearing from you. Let's see who we're hearing from on the program today. Holding down the CME and FTSE Russell hot seats today, we've got CARLEY Garner, the senior analyst and broker over there at DECARLEY Trading. She's also the author of a few books, including Trading Commodity Options with Creativity, Higher Probability Commodity Trading, and a trader's first book on commodities. CARLEY, welcome back to the TWIFO program.
Thank you. It's good to be here. Appreciate it. It's been a rough week, so if I sound a little drab, you'll know why.
I was going to say, you picked a boring week to come on. Not much to talk about at all this week. You know, it's kind of, we might as well just end the show now. There's literally nothing to talk about.
Right. I really miss boring weeks. I'm telling you, this is getting crazy.
It's like we haven't had one of those for a couple of years now. So yeah, a little bit of boredom. I don't want a whole 2017 again where nothing happened, but a little bit of boredom could go a long way right now. Know what else goes a long way, listeners? It's the Movers and Shakers Report. So let's get to it.
It's time to find out what's rallying on the light side and falling to the dark side at CME Group this week. It's time for the Movers and Shakers Report.
All right, everybody. Welcome to the Movers and Shakers Report, the portion of the show we break down everything lighting it up to the upside, a.k.a. the light side, and to the dark side. Over there at CME this week. You probably can guess what's moving and shaking this week, but nonetheless, let's crunch the numbers. CARLEY, you are our guest. I will give you pride of place. Where should we begin our journey this week? To the light side or to the dark side, madam?
Let's go dark.
All right, let's do it. To the dark side we go. And actually, if you check out the reports for yourselves, listeners, which you can do if you follow CME over there on Twitter, we also tweeted out right before showtime as well. You will see that we are, shall we say, a little bit green biased this week. So not a ton of dark side to sink our teeth into, but we shall endeavor to do so nonetheless. Number 5, things are getting a little quiet, at least to the dark side, when we've got FX making it into the Movers and Shakers. It doesn't often happen, but number 5 is the peso, the old peso USD, off about 1/3%. So that kind of shows you the slim pickings on the dark side this week. Number 4, live cattle, off 1.12%. Number 3, the old Euro USD, off about 1.12%. Maybe if there's time. I'm not sure if there will be time, but maybe if there's time, we could parse a little FX. It's been quite some time since we've done that on the show. Number 2, feeder cattle, off 1.52%. It was number 4 in the same direction last week, off a little over 5%. And number 1 to the dark side this week, taking a bit of a breather, is the euro dollars, off over 11.34%. Again, take some of those numbers of the euro dollars, bit of a grain of salt. It's kind of a bit of a moving target with so many different expirations all going off at once, but still a lot of dark side there for the euro dollars this week. To the light side now we go. Now, if you're going to guess the usual candidates out there of Bitcoin or lumber or maybe nat gas, you might be a little bit surprised this week because none of them are in our top 5 this week. Bitcoin's actually only number 9. It's still up almost 11%, 10.97%, but it's not enough to crack the top 5 this week. That shows you how much action we have in the upside this week. And a lot of it is going to be in the ags, listeners, and of course, a little bit of energy. Both of those a little bit in flux right now. Number 5, KC wheat, up 17.86%. Listeners, that's a huge move for wheat, and we're not even done talking about wheat. Number 4, WTI. You've been seeing the headlines, crude getting a bit of a lift off of this Ukraine situation out there. That continues this week. WTI up 18.66%. Number 3, it's RBOB, up 19.79%. Staying in the energy for number 2, listeners, it's heating oil, up 21.07%. And the big dog this week, listeners, kicking Bitcoin to the curb, kicking nat gas to the curb, kicking lumber to the curb. It's Chicago wheat, up 29.59%. I mean, these are just historic numbers here for wheat. So I do believe we have to start our journey this week in the ags.
It's time to get our hands dirty exploring the latest options, trades, and trends in corn, wheat, soybeans, and more. It's time to talk ags.
Some of our listeners were prescient. Everyone was talking about energy in the lead up to the invasion. Some of our listeners were asking about the impact on the wheat markets, and they knew what they were talking about because these days it's all about wheat out there, listeners. Hovering right around 14-year highs. I mean, you don't get a nearly 30% pop in a week in wheat every week, listeners. Those are pretty impressive numbers. If you're wondering why, of course, Russia and the Ukraine, pretty substantial wheat exporters, almost 30% of global wheat exports coming from the combined area. Of course, Ukraine under flux. There's also concern about this, not just this year's harvest now, but if they're fighting and things are getting destroyed, who's going to be out there planting for next season? So this could be a longer, more systemic issue. Also ports into the Black Sea and everywhere else being shut down. So a lot of issues out there structurally, which could lead to a longer term disruption of all things wheat. By the way, if you want to check out the ags for yourselves, you know where to go. cmegroup.com/TWIFO, TWIFO is the place to go to check out these reports, not just during showtime, but whenever the heck you want to listen and read about a little bit of commodity action. In this case, we're going to start in the ags, listeners. So go to that drop down, go over to ags. It's all alpha order, so it's easy to find, right at the top of the list. Then we're going to hang out, go down a couple of notches, go below the grains and oil seeds and corn, and click on the wheat, and we're going to hang out in SRW wheat first, which is, of course, the Chicago wheat. CARLEY, I do believe it was the last time you were on with us, maybe in our pro Q&A where our listeners were asking you about wheat. So they were early on to this disruption, but obviously ags coming in the spotlight in a way they haven't in some time. CARLEY, what's been lighting up your tape over there at DECARLEY this week as we're seeing this incredible upside in wheat?
You're right. So someone did ask me about the potential impact in wheat, and at the time, honestly, it wasn't something I had really thought a lot of. And as time went on, that person actually gave me some good insight.
Our listeners are a clever bunch, are they not?
Yeah, they really, really are. And as it turns out, we all know what happened. I wish I would have listened a little louder, to be honest. Like this is just on a complete side note, but wheat has not been good to us this week. We came in long futures, long calls, but we sold calls against it, thinking we'd hedge against the volatility. And guess what? That did not work out well. As the market's been going locked limit, the options have just ridiculously exploded in value. So even in places where we're fully hedged with futures, it's the losses in short options are outpacing the long futures, and it's just completely messy. So it's no fun. If you're not in this market, actually, you be thankful, because even if you're trading futures, we went from on Friday, it was limit down, back to limit up on Monday, and then it's just been limit up ever since. So it's whether you're trading futures or options or hedging with futures or options, honestly, it has been a mess. And I think that's obviously there's good reason, like fundamental reason for prices to be higher than they were a few weeks ago, obviously. But with that said, I think a lot of this price gain is really just traders positioned on the wrong side or weren't necessarily ready for it. And so if you look at the tape, the daily volume is pretty big, but what's happening is the market's mostly going locked limit overnight on, a couple thousand contracts traded. So it's really just a relentless and just kind of an illiquid environment. So it's tough.
That's a good point you bring up about the lock limit, because a lot of our listeners coming from the world of equity options starting to dabble and dip their toes into the futures options are probably not that familiar with that. But you're right. What you're kind of pointing out is kind of a bit of a worst case scenario. Even if you have the futures against it, which you think you should be hedged, when you're lock limit, those futures are paused, and yet the options continue to print in crazy, wild and wide markets. Maybe walk our listeners a little bit through that scenario for those of them who aren't familiar with it.
Sure. So it's really frustrating and quite scary, because the even if you had a bullish position coming in, but let's say you're the type that does covered calls or maybe bull call spreads and hedge with futures or whatever the case is. Let me just pull up an option chain here. Now, to be honest, I have no idea how the exchange is going to settle some of these options, because if they settle them at where they were trading at the close, it's basically going to trigger mass margin calls on everyone's statement, because for example, the futures can only go up 75 cents in one session. That's the current limit price. Once it hits 75 cent limit, or it's up 75 cents on the day, you can sell it, but you can't buy it. And so what happens is a whole bunch of orders accumulate trying to buy wheat at the limit price, but there's nobody willing to sell it because it's just an illiquid environment. So anyway, what happens is the options remain open. So the futures are locked. You can't get out of your futures if you're short. You can't get into futures if you want to buy to hedge your options or to just go long or whatever the case is. But the options continue to trade. So there were some instances that I was looking at with the futures up 75 cents, and at the money option was according to the bid ask, and it didn't. Most people opted not to trade them at those prices because you have to really be desperate to get out at those prices. But according to the bid ask, instead of the option, an at the money option being up 60 to 70 cents, which is what you might expect in high volatility, it was up like $2.30. So, I mean, that's like an $11,000 move when your futures really only picked up $3-4 grand. So that's tough.
Yeah, that's definitely a rough scenario. And again, for a lot of our newer listeners, maybe something they're not that familiar with. A lot of you have written in with questions about why do your options P&Ls get so crazy and wonky at the end of the day. This is a somewhat analogous situation. Your futures, instead of being closed, are halted, but the options are still widening out, but they're still printing. And so you have these crazy markets that are probably not really reflective of what's actually going on as people are trying to speculate where the futures would be if they weren't limit up. And so, yeah, it's a bit of a worst case scenario. Again, not for the faint of heart, listeners. If you're thinking about maybe dipping your toes into the wheat markets right now, given this run up, maybe take Carley's word of caution and live to fight another day out there. Let's look and see what's been lighting it up out there. Again, it has been limit up a lot, so that's kind of been stymieing things, but we are still seeing a lot of paper out there. By the way, if you don't follow the wheat markets right now, we're at 1134 in that Chicago wheat future right now. That's up 274 and a quarter handles, or about 32%. Off the top of your head, Carley, can you think of another time frame where we've seen this aggressive of upside in the wheat markets in such a short time frame?
Not in this short of a time frame, and not this aggressive. No, I do remember there was a time in 2008 that the wheat market went berserk, and it actually printed up in the $13 price range. But honestly, that was, from my understanding, there's a lot of things going on at that time, but there was actually a pretty big fund, or actually, now that I think about it, I think it was a rogue trader, kind of skirted the brokerage firm's risk parameters and put in some really big orders and got blown out. I could be wrong, but I want to say it was MF Global, and it really put a big dent in their finances. But so there was some really weird shenanigans going on then. But even then, I don't remember it being quite this. It wasn't like this. This is something I've never seen. This is crazy.
Do you guys do typically a lot of ags over there at DECARLEY, or were you kind of just attracted by the vol and the volume going up this week?
We do a lot of ags, but it was. We've been in the grains for a while. We've been bullish the grains for a while, which is why this is so hard to stomach. Sometimes, sometimes as a market participant, sometimes you really want to hedge your risk, and you're long, but you're worried the market's going to roll over because it's overbought, and it's never really gone higher than that. But it doesn't always work. Most of the time, it works. Now, I want to also mention this is a really rare event, so you shouldn't change your entire approach to trading or markets on just one crazy wild event. This kind of thing, like in wheat, it happened in 2008 and now. So we're talking like a 12, 13 year difference. But most of the time, you're better off playing it safe and hedging. And it just works out that this particular time, that was not the way to do it. But so we'll see. I don't know. Crazy time in the grains. And the interesting thing is with wheat going berserk, it's kind of pulling everything else up with it. Now, corn and beans were holding their own anyway. We've had some big rallies in the grains all the last couple of months, but a lot of that volatility has bled into corn. And another thing to keep in mind is if you are going to participate in these markets, and to be honest, if you're on the sidelines, I'd probably stay there. It's just not worth it. It seems attractive because there's all kinds of premium out there and there's all kinds of volatility and fun things happening, but it's a really tough environment to come out ahead in, because one mistake is just exacerbated because things are moving so fast and markets are going locked limit. Just today, corn was locked limit higher. So it's tough out there, but keep in mind, a lot of this volatility is in the front month also. So we're talking like May wheat, May corn, May soybeans. If you look at the back months, they're a lot tamer. So I would suggest if you are going to play the back months, at least you're probably not going to get your head ripped off like you might the May contract.
Let's look at some of that vol out there in wheat right now, listeners. Yeah, and it is, I think to say frothy is putting it mildly. The contract, the weekly March that's going out tomorrow, it's 153 vol. Obviously, that's mostly gamma, not a lot of vol in that contract left. But still, that tells you what kind of levels we're talking about from vol. By the way, how much paper going up this week out there in wheat? Nearly 300,000 contract. That's a pretty rock'em sock'em week for wheat, even with all the issues we just laid out. And of that, nearly half, 47.5% of that paper going up in the May contract. So pretty much half of the paper. We're going to hang out there. That May contract has about 50 days to go. And if you're wondering, that vol is still at a frothy 68.25. That's up nearly 27 points. You go a little bit closer to home. You go to the April contract that has about 22 days ago. That vol is 126, listeners. So I think to call this futures curve a little backward is underselling it. There's a lot of juice in the front portion of that curve. To CARLEY's point, if you go out a little bit farther, you go out to, dare I say it, all the way out to December, you're talking a 960 on that future. So you're off substantially from where the nearer portion of that curve is trading, all hanging out there at about 1134 or so. So a lot to unpack, but we're going to hang out here in the May contract. The vol, like I said, 68.25, up nearly 27 points. And that's a lot of vol here this week, listeners. Skew these skew numbers, they don't even make sense. They're so extreme. Last week, the puts were 67% cheap, below that. Nobody wanted to touch the puts, and the calls nearly 40% bid. Again, some of this reflecting some of that illiquidity out there that CARLEY was talking about earlier. This week, things have actually settled down a little bit, which may surprise you, but the puts only about 8% cheap, and the calls this week only 7% bid. So again, we've blown through most of the call strikes that were bid last week anyways. Not a lot left to bid unless you're extremely optimistic. You think there's a lot more upside to be had here in wheat above these 14-year highs. In terms of the most action, you may be saying to yourself, what was the hot contract out there this week? And as we blow through the par strike, the 1,000 strike, not surprising to see that one dominating the tape this week. 15,600 of the 1,000 calls going up out here in May this week. Pretty active all week long. The busiest day was yesterday, about 6,500 yesterday. A lot of that closing. So I guess as we broke through that strike, people scrambling to take it off. Tuesday, 4,300. Monday, 3,800. Today, actually not a lot, only about 1,000 going up today. So maybe reflecting some of those limit issues that CARLEY was talking about. Number two, right behind it, we have the 1,100 calls. So a bit of a call strip lighting it up this week, listeners. About 11,000 of those going up this week. The big day again yesterday, 6,000 there. So maybe some rolls going on there from the 1,000, the par to the 1,100 strike. Very similar size paper going up there both days. Also about 3,600 today. So active today, unlike the pars, and 1,100 going up on Tuesday. And right behind it, we have the 1,200. So again, a bit of a call strip here. No surprise. The big day also yesterday, 4,100 of the 1,200 calls going up yesterday, followed by 3,800 today. So it remains active today, and 2,500 on Tuesday. Not a lot going up on Monday in pretty much most of these strikes. Let's look a little bit farther afield, see if we can see any other aberrant prints here. Again, 1,300 is going up. A lot of calls going up this week, listeners. You have to go all the way down, looks like, to the 900 puts to find the most active put contract this week. And they only did 4,200 contracts. About half of that today, 1,200 yesterday, and 1,000 on Tuesday. So there were some puts going up this week, but not a heck of a lot. CARLEY, has any of that surprised you? Is that pretty much what you expected in terms of options activity and skew and volatility?
No, that sounds par for the course. I'm not surprised. Not surprised for the numbers. I'm surprised to see what we've seen this week.
Yes, that is definitely true. You want to hang out a little bit more in the ags, or should we head on into energy next? You're our guest. I'll let you choose where we go next.
Sure. Energy's not much more pleasant, but let's talk about it.
Yes, not much more pleasant either. So let's move our movable options feast over there next.
It's time to tap into the deep options well of black gold, Texas tea, nat gas, and more. It's time to talk energy.
All right, everybody, welcome to the energy sector. You guys know where to go to find this. Go back into that drop down, pop it out of ags, scroll down a couple of notches to energy, and then we're going to hang out here in crude oil first, and maybe we'll get to nat gas a little bit later as well. CARLEY, a lot's been lighting it up in the world of energy. A lot of the focus has been nat gas on the show of late. That's been one of the big movers and shakers, but WTI, no slouch there as well. Back over the par strike, the 100 strike here for the first time in quite some time. What's been lighting up your tape in the world of energy this week?
So you're right. It's basically exactly what we saw in natural gas last fall with the explosion in volatility and all the chaos is now playing itself out in crude oil. So we went from crude oil has been in a pretty strong uptrend, obviously, since early December. But it had been relatively tame. We did, when the Ukraine-Russia stuff started coming about a few weeks ago, we did start seeing some vol come into the options. And to be honest, I thought that when Russia invaded Ukraine, I thought that was kind of the fireworks for volatility and the market reaction. But as it turns out, that was literally just the beginning. And so, there's been some tough trade on the tape there as well. I know anybody that tried to hedge, like, for example, we had clients, unfortunately, with similar situations in wheat. We had bullish and, well, we had kind of neutral spreads on option spreads. And when the market had first started to rally above 100, we scrambled to buy futures against it to hedge. But anybody that did that was sorely mistaken. Actually, I think we started hedging in the high 90s, but it really doesn't matter. The first time we reached 100 in the front month, it literally dropped $10 immediately afterwards, and pretty much shook out anyone that tried to hedge their upside risk. And that's, I think, what paved the way for this really big volatility spike, because anybody that hedged on that initial rally was probably washed out. Most people won't hold on to a hedge for $10, $11 in crude oil. That's $11,000 per contract. And so when the market opened back up on Sunday night and it immediately started pushing higher, it was hard for people to get hedged. And then as it just kept pressing higher, and I mean, we're seeing moves in oil that normally take months at the shortest, but probably several months, and we're seeing it in a day. So plenty of volatility, most of it bad. I'm guessing that a lot of people were caught on the wrong side, and that's why you're seeing all the big spike. I would also point out that if you look at the spread market, the spread between the front month and the back months just went wildly into unnatural levels. So that tells me there's probably a lot of spread traders that were caught off guard. For example, if somebody was short the front month, the April, and long June or July, what they found was April was screaming higher, but their hedge position, which was being long the back month, was barely moving higher at all. And so it squeezed a lot of traders out, from what I can see, and probably was pretty painful. So hopefully somebody made money on it. Wasn't me.
Yeah, the spreads definitely got whacked this week. Looking right now again.
They did.
WTI very backward again here. The front future there going out in a day about a 108, and you go out to, let's go to December. It's at about an 87.5. So quite the chasm. All the folks who are trading the spreads, listeners, easily could get caught on the wrong side of that. By the way, how much paper is going up this week in WTI? If you said almost 1 million contracts, you got the winner chicken dinner. It's already over 900,000, 907,000. I can't remember the last time you saw that much paper going up in WTI. That is nothing to sneeze at out there. And of that, about 40%, 38% going up in the April contract. So we're going to hang out there. April has about exactly 14 days to go. So it's right at our typical cutoff there, our frame of reference, listeners. Right now, WTI, as we kick off the show, almost at 108, 107.90, up another 16.3 points, or nearly 18%. Again, like CARLEY was saying, we're seeing epic moves play out over the course of a couple of days out here in WTI these days. What's that vol now out here in WTI? If you said 76, you're also the winner out there. 76 and about a third, up 26 handles just over the span of this week. So a lot of vol surging into WTI as we're hitting these astronomical levels. Let's look at the skew here really quickly. Kind of a similar story to wheat, in that things were extremely outrageous last week, a little bit more settled this week. Last week, the puts were 8.3% cheap to the at-the-money vol. Last week, the calls, 16.9% bid. So there was a lot of premium in the upside calls. Hard to argue that wasn't merited given the move we saw over the course of this past week. This week, the puts have come in quite a bit. The puts are now only 2.1% below the at-the-money, and the calls 6.4% rich. So not a heck of a lot of skew out there in either direction right now. So maybe that indicates a little bit of the market settling out. Let's see here. Let's look at some of the paper that we've seen going up this week. And looks like it was the 120. Man, 120. These are strikes we have not talked about. I mean, it was just not that long ago. It was in the nadir there, the sell-off during the Omicron fears in late November, where we hit, in the 60s, low 60s again in WTI. So you're talking a 40-odd handle rally since then. So these are levels we have not seen in quite some time. The 120 strike lighting it up this week. The 120 calls, listeners, doing 22,245 contracts. The big day was yesterday. 8,200 going up on the tape. 6,800, so almost 7,000 today. 6,000 on Tuesday. Not a heck of a lot going up on Monday, followed hot on its heels by the 110 strike, doing about 21,000 contracts this week. The big day for that was actually Tuesday, about 8,000 going up on Tuesday, 5,000 on Wednesday, almost 5,000 on Monday, and about 3,000 today. And looking a little bit farther afield, let's see. We also have the par calls. Actually, surprising the par calls didn't get much action this week, only 15,000 contracts there, given how much of a historically significant level that is, as CARLEY just mentioned. Once we broke through it the first time this week, it immediately retreated. Now let's look really quickly to see if we see any other interesting strikes going a little bit farther out. Seems like it's, as you might expect, listeners, all calls all the time. The par calls trading 14,000 times here in June. The 120 calls going up 5,000 times here in July. Par calls also active here in August. 110 calls here in October. So pretty active across the board, as you might expect on the call side. I don't see any really aberrant. You have to go all the way down to about a little bit less than 14,000, 13,700 to find the most active put this week. That was the 90 puts, also here in April. Again, doing about 14,000 contracts. The big day for them was Tuesday with about 5,800. The rest of the week, much less. So intriguing stuff here. Kind of all calls all the time, which I think most people expected. Looking a little bit farther out, I don't see. The 120s were also active in December of 2023, doing about 6,000 contracts there. So it's kind of all calls all the time across the entire term structure. Is that pretty much what you expected as well, CARLEY?
Yep, that's not surprising. I mean, technically we've got a breakout here. I personally think that this is crude oil's in the process of a blow off top, very similar, or actually the opposite scenario that we saw in like April of 2020 when the market kind of blew up and then reversed. I think we're seeing the same thing. But if you recall, before the oil market bottomed out, the front month dropped below zero. So, I mean, things can get really, really crazy yet before we actually start headed the other way.
That's
so
true.
even if I'm right and this is a blow off top, that doesn't mean we top out at, maybe tonight, last night's overnight highs were around 116. Maybe those hold. Maybe it's 125. Maybe it's 130. Who knows? It's going to be really crazy. So just be very careful out there.
Yeah, it was coming up on almost 2 years ago that we were negative. Wasn't it April? Yeah. We forget we can go negative here. So yes, that's quite the rally from negative to where we are right now.
Yep. It's unbelievable. Hard to believe.
You know what else is unbelievable? It's not in our movers and shakers this week, but we also have to talk about it because it is still very much dominating the tape. It is nat gas. I know, CARLEY, when you're not out there slinging wheat and WTI, you've been pretty active in nat gas. What's been catching your eye out there this week?
So natural gas is not seeing quite the volatility that crude oil is, which is interesting. But like I said, I think we just kind of went from one obsession to the other. And so natural gas is behaving itself, which I like to see. I do think that long term, I think we probably do see much higher prices in natural gas, but my best guess is we retrace from here. So I wouldn't be shocked to see kind of a retest a trend line, which is going to be in the low fours before we resume an uptrend. But then again, I'm kind of gun shy of making too bold of guesses at this point.
I like that. Natural gas is behaving itself. Let's see.
Yeah.
Let's see what kind
for
of
once.
Well, for once, you're right. Let's see what kind of paper we could see out here in this behaving itself market. Still a pretty active market, listeners. Coming into showtime now, we're seeing nat gas at about 472. It's up about almost 5.5% on the week here. Still not enough to break into the upside movers and shakers this week, listeners. You needed quite a big move to break into the top 5 this week, but still 471,000 contracts on the tape in nat gas this week. So that is nothing to sneeze at. And of that, about 37.5% of that paper going up in the April contract, which has about 25 days to go. So we're going to hang out there. How's the vol looking in nat gas? Well, as CARLEY mentioned, it's starting to behave itself, coming in a little bit. It's hit about exactly a 50 this week. It's off about exactly 7 points over the course of this past week. So that vol getting a little bit more manageable. It was in the triple digits not too long ago. So a 50, far calmer by comparison. In terms of the skew, last week the puts were 4.7% cheap. This week getting cheaper, 7.7% cheap. The calls last week, 8% bid to the at the money. And this week, 3.7%. So pretty much puts getting cheaper and the calls getting cheaper out there, which is kind of interesting. Let's go on out to the most active contract. And it looks like it was the 4 puts here in April that were leading the dance with about 26,000 contracts going up, almost 27,000 on the week. The big day yesterday, 15,000 on the tape yesterday, slightly biased towards opening. Seemed like a lot of back and forth trading yesterday. 7,000 today and about 2,300 Monday and Tuesday. And then right behind that, we have the 4 half puts. So kind of a bit of a put strip out here this week with going up about 18,500. The big day for those was actually Monday. About 8,000 going up on Monday, 5,000 yesterday, almost 5,000 today, and about 1,000 on Monday. Kind of back and forth opening to closing throughout the week. Also saw some action on the 5 calls, so it wasn't all just out of the money put strikes. There was some call action this week as well, nearly 19,000 of these as well. The big day was yesterday, about 6,700. Yesterday, 6,000 today, 4,000 on Monday, and about 2,000 on Tuesday. Let's look a little farther out, because one of the interesting things we have noticed on the show in the past was that there were bids and indeed trading activity on the 7 call strike all the way out to the end of the year. Now it looks like we're seeing 10 calls trading all the way for February of next year. And so interesting call action. If you know anything about the seasonality of nat gas, listeners, you know, usually seeing action and bids for upside call strikes all the way through the summer into the end of the year. Not typically what you see out there, but we are seeing that paper out here, even though a lot more puts lighting up this week than we have seen in recent months. We're seeing the 3 3/4 puts going up in July, about 4,000 times, 3 1/4 puts going up there in August, 3 half puts going up in October, 5,000, 3,500 times or so. So a lot of action on the puts this week, even though 6 calls also active here in June. They traded about 5,400 times this week. So not quite the call palooza that it has been in recent weeks. As CARLEY put it, I like that. The nat gas behaving itself. Let's go out now and see if the equity markets are behaving themselves. It's time to stroll on into the equities.
It's time to explore the volatility swings, skew changes, and hot options trades in your favorite indices. It's time to talk equities.
All right, everybody, welcome to the equities. You know, if we're talking equities, we have to start the conversation with some table setting, looking how the vol landscape is lining up heading into the start of our show here today. And we have seen kind of a weird day in the equities. We were rallying, then we're selling off, then we're rallying. So vol was kind of bid, then it was offered. Now it's kind of coming back down again. Still net down on the week. RVX, which is, of course, the VIX of the Russell 2000, the small cap VIX, at about a 34.5. When we kicked off the show, that's down a little over 3 points from this time last week. VIX cash, when we kicked off the show, just a tick below the 30 handle, about a 29.70. It puts it down about 2.6 points from this time last week. VVIX, so the volatility of volatility, also coming down a whopping 9 points, at about a 121 3/4 from this time last week. Vol Q, so the at-the-money vol of the NASDAQ 100, was at about a 30.5. That puts it down about 3 1/3 points from where it was this time last week. So a lot of those spreads have come in a little bit since this time last week. So the VIX to RVX, so the small cap to large cap vol spread, a little bit shy of a 5, about 4.85. That puts it about half a point, almost exactly tighter than this time last week. And the VIX to vol Q, so the S&P 500 to the NASDAQ vol spread, at about 0.75, which actually makes it about a 0.75 tighter. So those vol spreads starting to come in, which is kind of interesting. CARLEY, I know when you're not busy out there slinging WTI and wheat, you like to look at a little bit of the equities. What's been catching your eye out there this week?
Well, I mean, equities are obviously, it's been kind of a rough ride in the last couple of months. I'm old enough to know that equities tend to put in significant bottoms in March during corrections. So I'm not convinced that we've seen the lows yet. I think we may have one more pass at 4,000 in the S&P. But I do think that somewhere, if it does happen and we do swing back down there, that's probably going to be a low for quite a long time. If you remember March 2020, March 2009, I'm not saying this correction is that significant, but it is a big correction, and March is usually the time to look for really big dips to get bullish. So that's what I'd keep my eye on.
Yeah, we have had trouble breaking that 4,000 strike to the dark side. We keep bouncing well north of that. We shall see if the historical patterns can play out yet again. Let's look out here right now. We're talking S&P. Let's look really quickly here at the Russell 2000 as well. Small caps have had an interesting go of late. A lot of volume out there on the options front, a lot of movement we've seen this week. Actually kind of a surprisingly quiet week, all things considered. Only net off about 1% on the week. So a lot of back and forth. It is still north of the 2,000 level. For a while there, we had small caps languishing well below 2,000. Now back coming into showtime, we're at about a 2018, almost 2019 in small caps. If you're wondering what is the vol out here, let's go out to the March contract that has about 15 days to go. That did about 33% of the paper this week. The vol out there about a 33.5. So that's pretty close to what we're seeing out there in RVX. Remember, RVX is more of that kind of rolling 30-day implied measure. We're only going out about 15 days here in this March contract, but 33.5, that's up about 3.25 points on the week. So a little bit of action out there. And in terms of the most active contract, I said we're hovering right about 2019 or so in the small caps. It's the 2,000 puts that's been leading the dance out here. Looks like in March, that was where our most active contract was, over 1,000 going up out here this week. The big day was actually Tuesday, with a good chunk of that closing on Tuesday. It's like a 2,220 maybe vertical going up. Similar paper on both days on Tuesday. So maybe taking the 2,000s off, rolling them to the 2020 puts. So that certainly makes a lot of sense. Closing on the 2,000s, opening on the 2020s on the same day. So maybe a bit of a roll out there. Beyond that, everyone's always interested in the small delta calls, the 20 halves that are going out tomorrow. They were pretty active this week as well, and they would certainly qualify as small delta now. They have 1 day to go. So we'll keep an eye on those as well. In terms of other maybe interesting or aberrant prints, we've got the 1980s going up out here in the week 4 March contract, going up a fair amount. Those are a little bit below 2,000. Interesting strike, not one I expected to see here. And I know CARLEY likes to hang out in the S&P. So let's a quick swing into the E-mini S&P out there as well. See how much paper was going up out there this week. And yeah, it was, as you might expect, a pretty decent week. 2.8 million contracts on the tape out here in the S&P. Does it do some paper? Yeah, I think the answer is yes. And you know the deal in the S&P, 37% of that paper is going out tomorrow. So let's scroll down a little bit farther to find a contract we can actually sink our teeth into. Let's go out here to the March contract. That did about 17.5% of that 2.8 million contracts. That has about 15 days to go right now. By the way, the S&P coming into this segment of the show at about a 43.56, off about 24 points net on the week, or about 0.5% out there. Vol-wise, looking at about a 27.70 in that March contract, up about 4 points this week. Skew-wise, last week the puts were 20.1% bid, and the calls were 15.8% cheap this week. The puts, about 21% bids, not a huge change there. And the calls a little bit cheaper, 17.2%. So we're seeing that traditional equity skew just get a little bit more exacerbated, but not much. In terms of action, we've got a discount for the nonsense puts that always go up in the front week here in the E-mini. Yet again, the 36 quarter puts went up 61,000 times this week. Someone is in love with picking up the nickels in front of the steamroller. They were doing it again this week. If we remove those from the calculation, the most active contract this week was actually the 46 half calls in March, going up about 25,500 times this week. The big day was Monday, 22,000 traded on Monday. It looks like most of that closing, followed by kind of scattered amounts the rest of the week. So a big day on Monday, someone peering back their 46 half position. Maybe they thought that was a bit of a bridge too far. Maybe they had overwritten it and they were taking it off while the getting was good. Either way, 46 halves for closing was the big day. Also, 4400s going up this week for about 25,000 contracts for number 2. The big day for them was also Monday, 13, almost 14,000. So maybe a bit of that was closing as well, though. So maybe there was a 4,400, 46 half vertical that was up that they were started to take off. But either way, closing on both the 46 halves and 4,400s for a lot of this week, which again, given some of the action we've seen out there, maybe not entirely surprising. Let's look really quickly, see if I can see any other aberrant prints in this tsunami of paper, 2.8 million contracts. Looks like everything else is pretty much as you would expect. So, CARLEY, we're kind of coming up against it. We have time for maybe one more complex before we get to the listeners. So what else is floating your boat this week? Do you think we should squeeze onto the show?
Well, I mean, honestly, I've had my hands full with energies and grains, so I haven't really looked at much else. I'm kind of surprised that the gold market hasn't gotten more of an upside push than it has. I mean, we had a big rally at the end of last week, and it gave up a lot of that. And now it's kind of grinding higher. So I think gold and silver probably should be on the radar for potential breakouts. So that's something to look at. Another interesting thing I see in the currency markets is both the dollar and the euro are at extremely stretched levels, in my opinion. I know that not everybody thinks that, but I think we could be potentially in store for a reversal there as well. So look at possibly upside movement in the metals and reversal in currencies.
You mentioned currencies. I teased a little bit of Euro USD at the top of the show. We don't get a chance. People might forget we have it. It's so infrequently used. The FX drop. So let's head out there next.
The dollar, the euro, the yen, and more. It's time to explore what's happening in major currency options around the world. It's time to talk FX.
All right, everybody. Yeah, it's not broken. We have the drop. We just never have a call to use it, really. But yes, we're going to talk a little bit of FX right now. DeCarley, is this a big area for you guys over there at DeCarley, the FX space?
It can be. I mean, our clients tend to go where things are moving and where they think the opportunities are. So occasionally it's been so quiet in the currency market for, several months, and maybe you could even argue years. Really, we haven't seen any real big moves. So it's not something that everybody's watching, but yeah. So it's something that people are starting to nibble on. Let's put it that way.
Yeah, definitely. Just by looking at the number of times it's appeared on our show over the past couple of years, you could definitely say it's been a quiet couple of years in FX, but not so much this week, listeners. Let's go to Euro USD. It's the big dog out there this week. How much paper goes up in the Euro USD in an active week? We're closing in on 70,000 contracts. So again, it's no E-mini or Euro dollars, but it does do some decent paper out here. It's going to beat a lot of your precious metals out there. So intriguing stuff here. Again, it's no nat gas or even wheat this week either, but a decently active week nonetheless. If you're wondering, you don't follow the FX a lot, the Euro USD hovering right now at about a 1.1. That's off about 0.02 or nearly 2% on the week, which is a pretty decent size move in the relatively staid world of FX. And let's see, of that 69,000 contracts, 37% going up in the contract that expires tomorrow. So behaving very much like an equity out here. Let's go a little bit farther out. Let's go all the way to the April contract. That looks like about almost 30% of the paper this week, about 29%. That has 35 days to go. So we can hang out there. The volatility, if you're wondering, again, FX world not known for a lot of vol, and that's reflected in these numbers. The vol right now in this April contract, a 935. So it's shy of 10. It's still up a little over 2, about 2.2 points. So a big vol move this week out here as well in the Euro USD. In terms of skew, last week the puts were pretty bid. They were nearly 16% bid to the at the money. Again, some of that is going to, just because of the overall low level of vol we're talking about, it's easy to have a 16% bid above that. But still, nearly 16% bid last week. This week, it's come in demonstrably, only 4% bid this week. Last week, the calls were 10.3% cheap. So you had quite the skew on last week. Calls 10.3% cheap. The puts were 16% bid. So a lot of skew action out here in the Euro USD. This week, that has come in as well. Only about 2.9% cheap this week. And in terms of the most active contract out here, listeners, again, these strikes are a little bit funky. The 1.11 puts going out tomorrow did about 2,600 contracts. The big day for those was Tuesday, about 870 and about 750 on Monday. Followed right behind it by the 1.095 puts as well, doing about 2,200 contracts. The big day for those actually today. Then if we go on out to the April contract we were just talking about, the 1.095 puts were pretty active out there as well, doing about 2,000, almost 2,100 contracts. Almost all of it on Tuesday, 1,800 going up on Tuesday. Pretty much all of that closing. So a lot of people unwinding, looks like those 1.095 puts out there in March. Again, these are not products we get a chance to sink our teeth into very often. I just kind of want to scan a little bit to see if we see any other interesting or aberrant prints popping up here on the term structure. Seems like it's mostly on the order of those same kind of puts. So if you get a little bit farther out, 1.15 calls. We're trading in June almost 1,000 times. 1.15 calls also pretty active in July, about 1,000 times as well. So that seems to be, there is some longer term call activity, but in the near term, it seems like it's all puts all the time. Listeners, we got a little bit of time left. Let's see if we can squeeze in some of your questions. It is time for your futures options feedback.
It's time for your questions, comments, and insights. It's time for Futures Options Feedback. Submit your questions at twitter.com/options, facebook.com/The Options Insider, stocktwits.com/Options Insider, or via questions@theoptionsinsider.com. You can also submit your feedback via our Options Insider Radio Network mobile app, available for iOS, Android, and Kindle Fire devices. You can even ask your questions live via our Mixlr chat room. So grab the Mixlr app or just search for Options Insider at Mixlr.com. That's MIXLR.com.
All right, everybody, welcome to your segment, the Futures Options Feedback segment. You guys know where to find us at Options on most of the major social media platforms. You cool kids in the Secret Club can always ask your questions live anytime for the shows throughout the week. And let's see. First up, we've got Ellie here. Ellie wants to know, has anyone done straddle studies for the futures options market similar to what ORATS does for the equity options market around earnings? I think that would be interesting information, particularly around events like OPEC meetings and crop reports. So, I'm with you, Ellie. I think that would be very interesting. If you're not familiar with what she's referring to, listeners, we have a lot of great reports on our site from our friends over there at ORATS who do a lot of earnings straddle analysis for the equity markets. That's obviously a big driver of a lot of options paper out there. How much volatility they're pricing in? How does it perform compared to historic events and a lot of other things that are very easy to do in the equity space because there's a lot of data available. Not so much in the futures option space. In fact, I'll have to ask Nick about this. He probably would be one of the best suited, Nick and his team over there at QuickStrike, to actually do something like this. But to my knowledge, Ellie, I have not seen a lot of, maybe there's some individual, maybe some research houses that put out maybe a little bit of research on, let's say, beans or WTI, whatever the case may be, whatever their specialty is. But I haven't seen anything that's kind of broad and far-reaching across any of the markets. But maybe, Carly, maybe you're aware of some research that I am not. For Ellie here, are you familiar with anyone who does straddle studies around big commodity events that they analyze using the straddles and the options?
I am not, unfortunately.
Well, there we go. I thought you could have some secret study up the back pocket that I was not aware of that was going to break it all free for everybody. But no, Ellie, sounds like that's a good question. I might take that and put that up to Nick and his team. They're going to love me for giving them more work, but it is a cool opportunity. You're right, especially around those moments, the crop reports or the OPEC meetings. Those are times when you might want to be armed with that type of event risk analysis. And yeah, to my knowledge, no one has done that. So that might be kind of interesting. Let's wrap it up on this one here, Carly. This comes from Rhythmic Angel. I just like that handle. He says, hi, Mark. Is it true that in futures-style options margining, and he puts in parentheses, there are a few commodities margined this way, as you know? The max risk on a long option is not the premium you see on a trade date, but the max risk can be whatever the premium is on expiration, hence making it similar to being short options. Carly, are you familiar with this futures style options margining here for Rhythmic Angel?
No, I have. That is new to me. I've never heard of that. The one thing I can say is with a traditional futures option, your risk is limited to what you pay for the option unless you purchase an option and you hold it all the way to expiration, and at expiration you don't offset it or don't do anything with it. And if it's in the money, the exchange will then exercise that option into a futures contract. And then at that point, your risk is theoretically unlimited because you are now in a futures position. So if you do let it go to expiration and you get automatically exercised, you can lose more than what you pay for the option. Otherwise, your max risk is what you pay.
Yeah, that's kind of what I interpreted this question to be as well. If you hold it through expiration, that's the only time I could see a unlimited risk scenario. Maybe you're referring to something else, Rhythmic Angel. You can follow up, let us know exactly what you're talking about, and we'll see if we can take it from there. Unfortunately, though, that music means we have no more room to take it on this show. We squeezed a lot of living into an hour, Carly. We talked about ags, we talked about energy, we talked about equities. We even got into FX. I haven't done that in forever, so that was kind of fun in and of itself.
It was.
But before we go, Carly, if folks want to check out what you guys have cooking over there at DECARLEY, or maybe they want to check out one of your books, where should they go? What should they do?
Sure. So our website is DECARLEY Trading. It's DECARLEY trading.com. There's all kinds of free educational material, videos, articles, things like that. You can also sign up for a free trial of our newsletters on the website. If you're looking to purchase books and learn more about trading, good, bad, and ugly, you can do so. Honestly, you can do so at any major book outlet, but they're cheapest on Amazon. So if you just search for CARLEY, GARNER, and Amazon, you will see you're going to see several books. Only look at the 3 newest, which are Trader's First Book on Commodities, the 3rd edition, Trading Commodity Options with Creativity, and Higher Probability Commodity Trading. Just ignore the others. Those are outdated.
Ignore the rest. So check them out over there, DECARLEYTrading.com. Excellent job, DeCarley. I'm sure we'll have to have you back on again. If these markets keep up, we may be talking again very soon, Carly.
Thank you. I'd love it.
All right, listeners. In the meantime, you know where to go to check out these reports for yourselves. CMEgroup.com/TWIFO, TWIFO/TWIO. This Week in Options also works if you want to check those out. And those, again, are running all day, all week long. So if you want to check your fluid milk markets at 3 a.m. on a Saturday, go ahead. No one's going to judge you. CMEgroup.com/TWIFO is the place to go. And of course, you know where to go for more information on all things small caps. FTSERussell.com is the place for that information. They have the great COVID impact study. They have all the information on all things recon, which actually is not that far away again. It seems like we just did that, but coming up in June, so they have those dates set and everything all along those lines, as well as what's happening with correlation between small caps and large caps. A lot of things to unpack. FTSERussell.com is the place to go. Also give them a follow on the old Twitter machine while you're at it, at FTSE Russell, FTSE Russell, all one word. We have to get on out of here, but don't worry, listeners. Back again tomorrow, noon Central, 1 p.m. Eastern, to break down the insane world, indeed the insane week that has been from a volatility perspective on Volatility Views. And then after that, for all of you Secret Club kids, 2 p.m. Central, 3 p.m. Eastern for Options Oddities. Then we're back again next week, all the way to next Thursday, another episode of This Week in Futures Options. Stay safe out there, everybody.
This Week in Futures Options is brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This Week in Futures Options is also brought to you by FTSE Russell, a leading global provider of benchmarks, analytics, and data solutions. Investors in the U.S. and around the world are using FTSE Russell indexes to benchmark their investment performance and create investment funds, ETFs, structured products, and index-based derivatives. Many Options Insider Radio Network listeners will be familiar with the Russell 2000 Index. Russell 2000 futures and options are currently trading on the Chicago Board Options Exchange and CME Group. For more information, please visit FTSERussell.com, CBOE.com, and CMEGroup.com. This broadcast is intended for informational and educational purposes only and does not constitute trading advice or the solicitation of purchases or sale of any futures or options. The rulebook of the applicable exchange should be consulted as the authoritative source on all current contract specifications. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.